Howdy, Jacob here. Today we're going to do a more in-depth analysis on MasterCraft Boat Holdings. It looks like, from my initial analysis, it definitely looks like a buy where you'd get a 15+% return buying it today. But I did some more research on the company by looking at their quarterly results, their 10Qs and 10Ks, and I've wrote down some notes on um, some of my thoughts and takebacks from reading those articles. But before, I want to give a quick reminder of the company's financials and just say that even this in-depth analysis is still meant to be reviewed in conjunction with your own analysis. It's only meant to help aid you in processing your own analysis, thinking if this is a good company to invest in or not. So to remind ourselves, it is in the leisure products industry, very small company, 383 million market cap, 322 million enterprise value. Current PE does look very cheap. Return on invested capital looks very inflated, but keep in mind that the more shares you buy in history, the more you inflate this number. But it is still very substantial with margins, at least in the most recent year, as high as 17%, with gross margins of 25%. So very little difference, meaning that the overhead to workers and everything and taxes and well, I guess taxes come afterward, but to pay your workers and everything is not the majority of their costs. It's definitely the cost of goods sold portion. On their balance sheet, it's pretty safe, 112 million cash-like products, 49 million in long-term debt, 4 million in short-term debt, and they do good. They make a good amount of money. Capital expenditures are a bit higher than what they were through them reinvesting back in themselves, which we can see, but so are their cash from operations. So their free cash flow is definitely higher, and their use of cash is quite a bit of reinvestments, a little bit of share repurchases, and then recently paying down a little bit of debt. So let's go over some of the notes that I took away from reviewing the company's quarterly reports, 10Qs and 10Ks. So the first thing that I noticed is that there was a change in leadership, 3/18/24. They came out with a report saying that the old CEO will retire. I believe he was 71, and he's retiring from CEO, chairman, and board by June 30th, but he will be a consultant for a year. So what that means is just if there's any advice needed or anything, I'm sure he'll be there to support, to make sure that the company that he's been on the board for since I believe it was 2008 or 2009 is still a promising company, and he's not just leaving them dry. But definitely something to know is that that's a pretty big change. After record revenues at the start through the start of 2023 post COVID, we're actually seeing the last 3 quarters have very large declines in demand. Year over year, the last 3 quarters, we saw minus 15%, minus 38%, and minus 37% from that same quarter of 23 to the same quarter of 22. Um, but outside the most recent quarter, net income was actually up. So it looks like they have been more efficient with making less, which is a positive. But the most recent quarter does show pretty big net income declines. The CEO cared, and I say cared because again they changed, but through the things that he talked about, it seemed like they really cared about operating cash flow, earnings, working capital management, share repurchases, and they still care about free cash flow, which is great. Putting that in your outlook is always good from my perspective, since free cash flow is one of the most important things that I focus on. They've been consistently buying back shares. I have that to the right over here, where they still have $41.5 million left of their share repurchase program, and we see that through 22 increased it pretty big. And remember, this is 6 months off, so their 23 full year was actually 6 months ago. So it looks very confusing saying 24 Q2, but this is actually the period through December 23. And so they have been buying back a good amount of shares. They almost do like the dollar cost average method, where we see that really for the last 6 quarters, they've just been buying back 200,000 shares roughly, no matter what the price is. And so obviously over here, you're going to get a better return than buying back at 33. But in the long term, you're just going to get the return that the business is going to do if you keep dollar cost averaging. So that's been their use of cash, free cash flow, a good amount other than reinvestment. So they have been giving money back to their shareholders through buying back shares, which is a positive. You just, again, every use of cash is that you invest in the business is the same of what the business is using, just on a lesser scale. So if they're buying back $41 million worth of shares and their company is worth $380 million, and you have a million worth of shares divided by 383, whatever. So they're using your cash to fund these things. You want to make sure they're buying back shares at extremely cheap prices. So I would have definitely preferred to see when the price was up here to buy less, and when the price was down here to buy more. And it should be on management to come up with intrinsic value and what they're going to get a great return on, and balancing out, should I reinvest at 12% with a 75% chance of working, or should I reinvest back into the company by buying down shares? They should be going through that, but it doesn't always happen. But just wanted to say that's their share repurchase program has been going on. Sales in the most recent 6 months versus the same period the year before are down 38%, so very heavy, like I said before. Gross margin is also down from 26 to 20%. Net income from 7 to 6%, with net income down, the margin down 7% to 6%, with the actual net income figure down 49%. Slightly offset on an earnings per share basis due to them buying back 4% of shares, but 109 million in cash-like products, 51 million in long-term and short-term debt. So no concern from the balance sheet. The free cash flow of 10 million for the last 6 months is down pretty heavily from its peak of 66 million. So even though their revenue is dropping a lot, they are still making money, which is a positive, but it's way less than it was when people were just buying these products like crazy. We see that their main three brands are MasterCraft, Crest, and Aviara, making up 68%, 24%, and 8% of revenue, respectively. For the most recent 6 months over the same year, MasterCraft declined 33%, Aviara 27%, and then Crest down 56%. So their largest brand of MasterCraft still was down 33%. That's pretty heavy. We are seeing inventories decline 26% over the last 6 months, so they're doing a good job of not having a whole lot of inventories on hand. And that's mostly due to 29% decline in their heaviest weighted inventory, which is raw materials and supplies, likely making the boats and their products. Long-term debt is due June 28th, 2026. Their top 10 dealers accounted for 40% of sales, with the top dealer accounting for 14.9%. So that's a pretty substantial amount. But as long as those companies are doing fine, then they're doing fine. But you have to think that the debt situation and the interest rates being as high as they are, if these dealers have high interest bearing debt and it's only going up, then that could be concerning for them. So you definitely want to look at that dealer and make sure they're in a good financial position. Their largest two suppliers of engines are Ilmor and Mercury Marine. Ilmor is under Ilmor Engineering, which I could not find any financials for, but Mercury Marine is under the Corporation of Brunswick, which is a public company. So I looked at their balance sheet, I looked at their cash flow statement, and everything looks fine. That's just to make sure that their main supplier isn't going to go under anytime soon. And it definitely didn't look like that. They had a fairly healthy balance sheet and making a good amount of money each year. So they hold 50 patents for the goodwill and 10 foreign. They're expected to expire in 2028 to 2041. So they still have a good amount of time with their product patents. And then MasterCraft has the number one market share in the ski wake boats with 21% market share. Crest brand is number 9 in the aluminum pontoon category at 4%. And then Aviara brand is number 7 in 30 to 43 foot bow rider category with 6.3%. So that's just, again, the notes that I took away from the company. And then I did a reanalysis with my updated assumptions, basically saying that revenues declined so much recently. I think that in the near term, there could be problems with interest rates being as high as they are, since people do finance these wreck vehicles, and they're just going to be spending less. So I have 0% in the fact that maybe it goes down pretty heavily, but then this is over a 7-year period, so it's likely going to go back up to what it is. And then didn't change the margins, since they've been doing really well at keeping very, very safe margins. I took the share change down a little bit and then the P down a little bit, and that gets us to a price that still needs to fall quite a bit. But it was a great review. I hope you enjoyed the somewhat in-depth analysis and do your own analysis. And have a great rest of your day. Thank you.